Hello and welcome back to CryptoVision, the channel where we explore the latest news and trends in the world of cryptocurrencies. Today we have an exciting story to share with you, so make sure to stay tuned until the end. We'll be discussing some interesting developments in the crypto industry that you won't want to miss. And if you're new here, don't forget to hit the subscribe button and the notification bell to stay updated on all our latest videos. So without further ado, let's dive into the story. Technological crypto companies were already on edge, but here's another bank that gave us a reason to panic, and it is precisely Silicon Valley Bank that has been working with startups in Silicon Valley for about 30 years. It suddenly revealed that it wants to raise capital by more than $2 billion. Many of the problems arose from the same US government bonds that were falling in price, and in September the bank had $16 billion in unrealized losses on bonds. In other words, it did not lose until it sold. But such a domino effect of the cryptocurrency startup carousel causes panic among depositors and forces banks to look for quick cash. In general, poor management of the bank's balance sheet, that is, assets and liabilities, leads to the fact that bank deposits as a source of funding and financing were less sensitive to changes in interest rates compared to assets. That is why the bank incurred more interest expenses, while 57% of its assets were long-term government bonds. If a customer deposited $1,000 in the bank bought its government bonds for that money. Then, the customer wanted to get his $1,000 back, but the bank could not do it. Its treasure was already worth not $1,000, but $950, precisely because of the rising interest rate. This is where the risks for the bank's capital adequacy came from, especially from March 2002 to February 23. The bank lost about a quarter of all deposits, plus losses without problems. Crypto companies also needed to cover something. The bank hoped that clients and investors would perceive the capitalization normally. Well, in general, issuing new shares is not a tragedy. It is normal practice. Under healthy market conditions, the bank would have simply bought new bonds with investors' money, waited for the old ones to be redeemed, and returned to normal. Waiting for the redemption of the old bonds would have been necessary precisely to avoid realizing this very loss. But the negative background of the market bankruptcies of Silvergate and also Peter Thiel, whom I will tell you a little bit later, predetermined the fate of the bank. The negative background was the overall decline in the investment market. Silicon Valley Bank's main clients were just its startups that used to easily attract money. But with the current interest rates, it is practically impossible to do this, and therefore companies are eating away at their banking savings. The technology industry is also going through a very difficult period. But with current interest rates at 8.5, it's almost impossible to do so. And that's why companies are eating into their bank savings. They literally need it to survive. The technology industry is also going through a very tough period. The venture market felt very good in 2020. One, according to many analysts' opinions, and partly our opinion as well, there was a bubble in these startups that went public on the stock exchange. Low, quality, and presumably progressive companies were coming out. And these venture funds and investors had large amounts of money that they were carrying. In the second year, the situation changed, and accordingly, they had to withdraw the money because they themselves began to lack business. They did not do anything new, and the bubble in the venture market burst in quotes. Probably the first company to do so was a small one that had more money lying around. It was a disaster for those who held their money specifically in Silicon Valley. And then everyone ran, and my clients ran to withdraw their deposits, and there was a so-called bank run. On March 9 alone, clients withdrew $42 billion, which is a quarter of the remaining deposits. Bonds began to be sold off with a loss of about 10%, which only fueled panic and capital outflows. The startuppers and venture funds themselves poured fuel on the fire, and especially the aforementioned Peter Thiel, co-founder of the venture fund, found. He advised clients to withdraw their money from SIF because of concerns about its financial stability. Other funds, such as Mechanism Capital and Eden Block, also advised companies in which they invested to withdraw money from CBA as soon as possible. In fact, Thiel's actions seem to resemble the statement of the head of Binance, Changpeng Zhaoyu, to hold tokens on the FTX exchange, which provoked panic around FTX, and this could well have been the self-fulfilling prophecy. It is clear that if this panic had not arisen, there might not have been a crash. But the situation was a little different. There was indeed a big and not very clean scheme inside FTX. Thank you for watching this video on CryptoVision. We hope you enjoyed this video. But wait, there's more. Be sure to stay tuned for part 2 of this video series where we'll dive even deeper. Don't forget to subscribe to our channel and hit the notification bell to be the first to know when the next video drops. Thanks for watching, and we'll see you soon on CryptoVision.